Hello, and welcome to our virtual presentation, the Murray Wealth Group Talks Spring Market Update. Thank you so much for joining us today. The Murray Wealth Group portfolio management team, Bruce, Jamie, and Mike, are with us today to provide their insight on the market and our portfolios over the last few months. The format of this talk will be in two sections. The first will be an exclusive company presentation by our team addressing some of your questions submitted in advance. And the final section will be a Q&A led by our advisory board chair, Susan Dalhoff, to give you, our audience, an opportunity to ask further questions of our portfolio team. Please feel free to ask anything about the information you heard today, our current holdings, or any questions you might have about the firm or a process. Without further ado, I'd like to pass it over to our CEO, Bruce Murray, for some opening remarks.
Hello, everybody, and thank you for joining us today. And we hope you enjoy our presentation and find it contains some information that might help you. I will talk initially about the economy and markets, and then Jamie and Mike will talk about the portfolio, and then we will talk about some companies, and then we'll go into a question period. The presentation should be about 40 minutes long. So Jamie, next slide, please. So this is, I think everybody on this call will know the market has corrected about 20% by the S&P this year to date. These long-term investors have to get used to these things. As you can see on the chart, this is the third one in sort of 4-year period that has hit us. And you can call it a correction, you can call it a bear market, but these are difficult to anticipate. If we'd sold in mid-2020 because the pandemic had hit and the market had recovered and was up, you would have missed quite a move. And so they're difficult. As long-term investors, we tend to run a fully invested portfolio and try to adjust to the market through stock selection. And Jamie, next slide, please. So the pandemic and the Ukrainian war have created a very volatile situation and somewhat caught the Fed offside. The Fed was trying to accommodate the slowdown in the economy through the pandemics and had cut interest rates. And then as they started to feel more comfortable, interest rates were allowed to rise into 2021. And then the pandemic shortages continued, China shut down, we got the Ukraine war, and all of a sudden we had an outburst of inflation that was not really anticipated. And so the markets have anticipated the Fed raising rates back up to the 3% level to get market rates up to 3% to try to slow the inflation down. It will be difficult. Next slide, Jamie. We're in a very unusual situation. This chart is kind of difficult to, it takes some time to understand, but the blue periods are when the Fed was tightening. And you can see that they are normally in periods of the economy doing well, rates, and the Fed is trying to slow down economic activity, not create it, or they're trying to anticipate inflationary activity. And you can see that they tightened in 2013, which was probably wrong, but then they started to loosen again in 17, and we had to, and the market got ahead of itself and pulled back. And then all of a sudden they were loosening again into 2020 and 21, and they're still doing that when the Ukraine war broke out and everything has reversed on me. So you've got a situation where the Fed has gone from tapering to tightening in sort of overnight. This is quite unusual. Next slide, Jamie. So we believe that valuation in the market is now at appropriate levels for investment. Fear and emotions are still high, and the outlook remains a bit uncertain as we still have some stuff flowing through from the pandemic and the dislocations in the economy. But valuations are back in levels that we're seeing in the mid-1990s when interest rates were substantially higher than we expect to see in the next 2 to 3 years. So 15, 14 times we're with 8-9% interest rates in the early 90s. So it's we're comfortable with valuation from a PE level. Next slide, Jamie. Thank you. And you know, a technical indicator here would show that, you know, equities, if they're not oversold now, they're really close to being oversold. This is the number of companies that are trading above their 50-day moving average, and it's, you know, it's a relatively small percentage, and they'll be largely energy and material stocks, and maybe special situations that are benefiting from the current situation. Next slide, Jamie. And so, you know, we've got a market that's reasonably priced, and we're expected to have earnings growth. These slides show, we just use the S&P, which is the first one on this chart, but these are the global markets. Top-down estimates, this is Goldman Sachs, are anticipating 5% earnings growth in this year and 6% next year. And, you know, the long-term growth rate for the market has been 6, 7, 8%. And so these numbers are not unreasonable. The bottom-up numbers show 10%, 9%, which are higher. And so we think that the economy and the earnings we're seeing earnings are coming from certain sectors, and other sectors are disappointing, which is maybe a little more unusual than normal. But we still think that the overall market is going to be quite acceptable once the emotional panic in the market gets out. Next slide, Jamie. And so, you know, like here we go, Shanghai shipping. The prices of shipping, which has been one of the major effects of the pandemic. You can see the delays out of China to Europe and North America haven't really moderated, but the pricing is starting to moderate. We're not sure what this means. This could be the fact that the shipping business is starting to catch up, or it could just be the fact that China is still shut down and there's a lack of product to be shipped to North America. So we'll have to wait and see on this one. So this is one that's still sort of unknown future. Jamie? And we do want to talk about inflation. Inflation is the current inflationary boat is caused by commodities. It's caused by the fact that you can't buy a new car if you want one. It'll take 2 years, and used car prices are up, and it's all physical goods. And we believe that once the economy moves through and we get readjustments, and we're starting to see this now with some of the retail companies not being able to, you know, having disappointing sales even though they've got products, so that you know, the inflationary boat should come down. You can see it here that metals and other things like wood products, if it remembers how you couldn't buy 2x4s to save your life a year ago, and so they've come back into line. And so things are starting to clear up. Energy remains the one thing, and that's largely because of the boycotting of Russian oil around the world. And it's going to take some time to clear this up, obviously, but we believe it will. You know, it's going to take, the market will discount it, take another year and a half to probably do that. Last slide, Jamie, is really, so here's the energy prices, and you can see that, you know, even gasoline and refined products, diesel and gasoline, are actually higher than the increase in the price of oil. So the shortage is being, you know, worked out across the retail channels as well. Natural gas is spiked high because of the dependence of Europe on Russian gas. So this is going to take some time, but you know, solutions are being announced every day. And with that, we'll just do a summary. And in summary, you know, we believe that the market is appropriately priced now for what's going forward. That doesn't mean, though, that fear and other things can't take it down, and take it down more. Nobody has ever been able to forecast the exact peak and bottom of markets, with the exception of, you know, the odd lucky person once in a while. And So we are starting to get comfortable. We're going to talk in our presentation. Mike and Jamie are going to run through the portfolios and how we look at them. And then we're going to talk about some specific stocks, the technology stocks in particular, where there's been the center of the media attention on the investment world. And so, Jamie, I'm going to turn it over to Mike, is it, initially?
Mike, you're on mute.
You're on mute.
Wow. You think after 2.5 years, they'd figure out that mute button. But thanks a lot, Bruce. Since we have such a great mix of people on the call, I thought it would be great to give some high-level color on the key characteristics of this Global Growth Fund, one of our two main products. In terms of geographical mix, the weights are 75 to 80% invested in foreign or global equities, and 20 to 25% invested in Canada. You'll notice on this slide we have a benchmark, and ours is weighted 75% of the MSCI World and 25% in the TSX. One of the most important attributes of this portfolio is that it's concentrated. We hold anywhere between 30 to 45 names. We currently have 36 names, as you can see on this slide, which means that every holding makes a difference. We take a bottom-up approach to our stock picking. We look at the merits of each individual company that we own. And we buy companies with superior revenue, profitability, and cash flow prospects, and management teams with successful track records and visions. Other key criteria we look for are sustainable above average earnings growth, above average ROEs, ROICs. And given that kind of criteria, they tend to be market leaders. These numbers on this slide are from the end of April. So 1 month means our April performance, and all the numbers are derived from that end date, April 30th. So 1, 3, and 5 year periods are all ended as of April 30th. And as you can see, the month of April saw no relief from the year-to-date trends, but the 2-year, which is not on here, 3-year, 5-year, and inception numbers are very good and are a true reflection of our process and approach. The 2-year number, which is not on here, the Global Growth Fund has a CAGR, compounded average growth rate, of 21% versus the benchmark of 15.5%. The upside downside capture at the bottom part of the slide measures the performance of the fund versus the benchmark, in this case over 5 years. In other words, how the fund does every day versus that benchmark. In our case, on average, if the benchmark is up 100, then the Global Growth Fund is up 151. And by the same token, if it's in down markets, if the benchmark is down 100, then the Global Growth Fund is down 116. And this is really how you would expect a growth fund to react in these types of markets. It outperforms in both directions, but in our case, it's more when the market is up. So that's actually a great thing. Let me give you some color on some shorter term performance since the beginning of the year. And maybe we can put up the next slide to show some of the names in the portfolio, in fact, an entire list. And it's in order of the highest weights to the lowest weights. And you can see the 36 names on the slide here. The biggest changes we made in this portfolio were shortly after the beginning of the Ukraine war. Given the potential impact on the medium-term outlook for oil and energy and the renewed interest in North American energy specifically, we decided to add 2 new names, Chevron and Whitecap. Before I go there, I forgot to talk about some of the short-term impacts on the fund in terms of detractors and contributors. Yeah, great. Leave it on this slide. The biggest contributors to the portfolio were Broadcom, Dollar Tree, AstraZeneca, and MasterCard. And the detractors were Netflix, Meta, Zalando, and Uber. And clearly the most unexpected and important events since the beginning of the year have been, as I mentioned, the Ukrainian war and the reemergence of COVID in China and the lockdown there. And as the famous Greek philosopher Epictetus said, it's not what happens, it's how you respond. So as I was mentioning, our response has been to move to Chevron and Whitecap. Chevron is the large integrated oil company. They have no direct exposure to Russia. And like all oil and gas companies these days, they have targets to improve their returns on capital. And maybe we could move to the next slide on that one. Yeah, thanks. Chevron, in their case, wants to take their ROCs from 6% this year to 12% by 2026. And Whitecap, which is a Calgary-based intermediate energy and exploration company, they plan to improve their return on capital to shareholders through a disciplined capital spending program. And as you can see on the slide, to make room for these, we sold TD Bank and WPP. WPP is a European global ad agency that basically reached our price target. As I mentioned, every one of our names has a price target. And in this case, WPP had reached our price target. We saw a better opportunity in Chevron. In TD's case, is a high quality company, but we felt more conviction for a trade into Whitecap versus TD in our outlook there. In terms of Chevron, we bought that at 148. That's 174 today, so that's up 16%. Whitecap is, we bought that at just below $10, $9.90 or so, and it's about $10.50, $10.60 today, so that's up 6%. TD, on the other hand, is down around 6% since we sold it, and WPP is down 20%. So on a very short-term basis, what we did at the very, very beginning of March has worked out. Even more recently, as in the last week or so, we sold Dollar Tree, which I'm not sure if some of you, I'm sure, have been on the call over the last several quarters. It's a name that we've been talking about in a very bullish sense in terms of all the initiatives they had. It actually did very, very well in terms of activist investment coming on board, and the stock price reacted very positively and in our mind, was reflecting a lot of the upside in the stock. On the other hand, Starbucks has been under lots of pressure with China's COVID meltdown and them pulling guidance from their whole the Chinese geography. And also Howard Schultz has just come in, the CEO, for the third time because things weren't working out. So there's been a lot of overhang of Starbucks. It's been very weak. We thought it was a good time to trade into that. I'm not sure if how many of you are multitasking right now, but if you want to pull up Dollar Tree on your screens, DLTR, you can see it's having a little bit of a weak day, as Target and Walmart have also reported very weak numbers the last few days. They're seeing the real impacts of on margins and inventories and high costs and the inability to pass on prices. So that's a good example of how we actively manage the portfolio on a daily basis. On the next slide, we have what I call our super slide. And it really illustrates how attractive some of these tech names have become. And we'll talk about Meta, Microsoft, and our stealth tech company, Linamar, in a minute. But broadly speaking, the tech stocks are on sale. And just to give an example on this slide, you can see, Meta versus Loblaws, let's take that. You get basically 5 times the revenue growth. If you look at the revenue growth column there, it's almost 17 times versus Loblaws 2.4. So 5 times the revenue growth, 2 to 3 times the ROIC, 33% versus a 13 for Loblaws. You get 10 times the net margins, 33% for Meta versus just barely almost 4% for Loblaws. Better balance sheets for a multiple, which actually, so if you look at multiples on the left-hand side, Loblaws trades at 17 times, Meta trades at 15 times. This is a huge sale on tech, just as an example for Meta specifically. Now, I think Jamie wants to talk more broadly about our holdings. Then I'll come back for Meta.
Yeah. Thanks, Mike. So we wanted to do a quick overview of the technology holdings in the fund, given, the NASDAQ, when Bruce was talking about the markets being down, the S&P down 20% year to date, the NASDAQ is actually down even more than that, I think closer to 26, 27%. So definitely a very, very hard hit sector. There's been comparisons to the 2000 tech bubble. And so we just kind of want to go through our holdings and why we don't think at least the companies we own are in any sort of bubble territory, and why we think they still have very strong outlooks from here. So, but certainly, like we've seen, they're starting to see some layoffs in the tech space. Capital is becoming tougher. It's not as easy to raise money. We're going to see huge markdowns on these private venture capital companies that were throwing billions of dollars at all these startups. So the capital pool is going to be drying up, and that's going to mean that for technology companies, your product has to have a good market fit, but you also have to make sure that you're financed and have capital or have cash coming in to make it through the next couple of months or next couple of years if we do go into some sort of slowdown, which it seems like is likely. And so I'll just switch your attention to this chart right here. I'll sort of walk you through it quickly. So focusing on that gray line, that's the easiest, the easy part of the graph. The gray line is just the company's revenue growth rate. So you can see on the far left-hand side, the first company there, Adyen, has a revenue growth rate of 35%. And this revenue growth rate is the 2023 revenue growth or revenue over 2022. So it's not just what they're doing currently, it's what is expected in the next 12 months. Twilio as well, growing 30%. And on the far end, Netflix still growing at a nice rate of 10%. And then so those bars on associated with each company, the blue bar is the cash or debt as a percentage of the company's market value. And so you can see most of these companies have blue bars on the positive side of the line. That means that these companies don't have any debt, or their cash position is larger than their debt. So they're in a net cash position, very, very secure financial position. You can see only there are the two companies that do have a little bit of debt on their balance sheet are Uber and Netflix. And with just around 10% of their debt to their very compressed market caps, given the share price reaction in the last few months for those stocks, it's still a very, very manageable amount. Given the typical industrial company maybe will have 30, 40, 50% of its market cap in debt. And then that orange bar there, that represents the next 12 months free cash flow that this company is going to generate as a percentage of the market cap. So if we focus on, maybe the two big companies we're talking about, Meta, which is Facebook, and Google, Alphabet, they have pretty big orange bars. They're going to generate about 6% of their market value, 5 to 6% of the market value in just cash flow in the next 12 months. So lots of cash coming in the doors for these companies, lots of cash on the balance sheet. That's why we think they're going to be able to make it through this downturn. They're going to be in the best position to keep employees, keep their top talent, maybe look at acquisitions of some other beaten down assets that they think they can integrate into their operations. And historically, acquisitions have been one of the best drivers of technology created investor value. If you look at Facebook buying Instagram or Google, some of the advertising acquisitions they did prior to the financial crisis really built those companies to what they are today. And so I think the main point to summarize is that all these companies, very, very strong financial positions, still growing at a nice rate. And now we've seen the market multiples pull back, as Mike talked to on the slide before, to very, very attractive levels. And so we think that once we get through this inflationary bout and interest rates normalize, we'll start to see these stocks outperform again. And now we'll talk a little bit more detail about a few of these companies, and I'll throw it back over to Mike quickly.
Thanks, Jamie. And this is everyone's favorite stock to hate, it seems, or company to hate, but maybe it's the best stock to own. Just as a reminder what Meta is, because they pulled a fast one last year, or maybe it was earlier this year, I can't remember. They changed their name to Meta, so everyone would forget about Facebook. But Meta is actually a family of apps, and that's Facebook, Facebook Messenger, Instagram, which Jamie alluded to, they bought in 2012, and WhatsApp. They also have an Oculus division. This is their virtual reality division, which is part of their Reality Labs. But stepping back, Meta has almost 2 billion daily active users, and they have almost 3 billion monthly active users across those family of apps. And just to give you an example of, this is our long-term approach to investing. We've owned Facebook since early 2016. As the initial thesis, they were perfectly positioned, which they were, to benefit from what the internet could deliver to advertisers. And this is really, advertising nirvana for advertisers. And that's the ability to target consumer preferences and measure return on invested capital for every ad dollar spent. And Facebook was extremely good at delivering this to advertisers. As they grew their users, They monetized their advertising across their platform, and they grew that daily average user from 1 billion in 2015 to the almost above 2 billion today. But that growth has matured in Europe and the US, but they're still seeing some growth through developing markets. And the hiccup last year was that this advertising nirvana that they had benefited from for so long was muted by an increased focus on privacy by Apple. In April 2021, Apple announced a strategy for better consumer privacy, which meant changes to their Apple-specific, what they called their IDFA, which is an identifier for advertisers. This is an ad tracking transparency feature used by advertisers. And typically you were automatically opted in no matter what app you downloaded. You didn't have to do anything. You were being tracked automatically by advertisers. So what Apple did is they changed it to an opt-in basis, which on the right-hand side of that screen, you can see what you get now when you download an app on an iPhone. You have to actually click on allow to track or not to track. And if you allow, then Facebook has the same visibility, and their advertisers have the same visibility on your location, not your specific location, but probably a postal code, your age, your kind of demographic stats, which makes it really, really attractive to target a specific group. They changed that, and now you have to opt in. That was the biggest change. So this has reduced advertisers' ability to target customers, and it slowed Meta's ad growth. Also, more on the Meta has also had some challenges because they've announced an increase in their investment in the metaverse, which is virtual reality, augmented reality, and their Oculus headsets. And this investment is 10 billion per year. That's a huge uptick in investment from previous years, and has hurt their margins big time, going from the 38% operating margins to 34%. So investors were not happy about that on the last call. And this investment has clearly spooked investors because some of them, like me, remember 3D TV, which is a huge failure, even though a lot of people threw a lot of money at that venture. So people have a nagging concern about maybe the metaverse will not be all the virtual reality it's cracked up to be. Also, TikTok, some of you may have that on your app, on your phone, has made a lot of headway in the terms of short form video segment. And Meta is trying to combat this with their Instagram Reels offering, but time will tell. So to sum up for Meta, it's a fairly mature tech company with high margins that have become under pressure. It has increasing competition at the edges, and it's investing in something that could be decades away. But we still think it's too cheap. It's 11% cheaper than the S&P 500 on next year multiple. So we're still backing our investment in Metaverse. Over to Jamie.
Okay, thanks, Mike. I'll just quickly talk about one of our other favorite technology names that also very mature, but sort of having a second phase renewed life for a stock that maybe like Meta was almost left for dead a decade ago and is now sort of showing it's the sequel. So Microsoft, I mean, we all know what Microsoft does. At a high level, they have an Office 365, Xbox gaming division. But the most exciting thing about Microsoft in the last few years has been its Azure Cloud Services division. And so Azure Cloud Services is the Microsoft Cloud. They compete against Amazon with their AWS division, and then Google as well through Google Cloud Services, which is a distant third player. Then there's a bunch of companies like the Oracles of the world who are, getting into the cloud business, but are probably just a 1 or 2% market share. And so this Azure Cloud Services, you can see on this Microsoft Intelligent Cloud chart, this is their entire Intelligent Cloud group. It includes other divisions as well as just Azure, but you can see when they really started to grow this Azure business in 2016, 2017, it was probably just about $3 to $4 billion of revenue in this time frame. And after growing 50% a year for the last 5 years, this is now a estimated $40 billion revenue business. So most of the growth in the intelligent cloud division has been from Azure. It was still growing north of 40% the last few quarters. It's actually cloud services that's seen an acceleration coming out of the pandemic, because every company realized that they need to move to the cloud and move to digitizing their platform even faster. So Microsoft is still getting that benefit as those plans kick in. And we think the cloud still has very strong growth long term. Like I said, it's growing 40% year over year at a $40 billion run rate right now. We think there's still lots of workflows and workloads to move on to the cloud. That's going to keep that revenue growth in the 20 to 30% range for definitely the next 3 to 4 years, maybe even 5 years. And then probably settle into a range around 10% for the second half of the decade. But that should get the Azure cloud division upwards of $100 billion in revenue as we exit this decade. So that is going to be a huge long-term growth driver. In addition, they just raised the price on their Microsoft Office 365 program for the first time in history. So it's just a small increase. It's 10% a month. Most of these products charge around anywhere from $10 to $50. So a 10% increase per user is just about call it a $3 to $5 increase per employee. So not a material amount for the value it provides, but when you bring that over millions and hundreds of millions of users, that number adds up, and that all flows right through the bottom line. I think I missed a number right here, but it does trade at a little bit of a premium. It's trading around 25 times its earnings, but again, we think these earnings are going to be very healthy growth over the long term. And then the final part to the story is the pending acquisition of Activision Blizzard and their Xbox division. This would be a very accretive deal if it went ahead. They're buying it around, I think, 20 times the last year's earnings. And if Microsoft continues to trade at a premium, that should really benefit the company. But there is some antitrust uncertainty. The deal is trading below the takeout price, so investors aren't sure if it's going to go ahead. Warren Buffett, for what it's worth, was buying Activision Blizzard shares because he thinks the deal is ultimately going to close, and you'll make a nice return if that happens. But right now, that's still up in the air of how that plays out. But that the Microsoft is such a large company now that even buying Activision, one of the world's largest video game companies, is really only about 5% of the total value of Microsoft. And they've also they have an active share buyback program, so they've reduced their shares outstanding by about 15% over the last decade. And that's something we see continuing as they buy back 1 or 2% of shares. So again, very unusual for a tech company to reduce their share count, given stock-based compensation is such a big part of the technology pay package across the board. And then this is just sort of a fun fact why Microsoft is able to grow this Azure business so strongly. So Microsoft has a data center in every company that it operates, in every country, and that's really important for legal and regulatory reasons. Whereas some other vendors only have a couple of countries where they operate their data centers. Well, data that's stored in a data center in a certain country is subject to that company's property laws and territory laws. So if you're say a foreign country and you're storing data on a U.S. data center, well, the U.S. authorities could and maybe would at some point have rights to go and seize that property or search that property. So by keeping your data centers in your home country, you sort of avoid unwanting eyes of other governments and other regulatory bodies. So Microsoft, with that coverage, it really gives them a big advantage in terms of growth. Now I'll toss it over to Bruce for one more name.
Yeah, so we're going to go from fancy high growth companies with high multiples and high growth rates to a company that we believe is both a growth and a value play. This is Linamar. Linamar is a Canadian gem of a company. And I'll just tell you, they are not in digits, but they're in machining. Linamar was the only company in the face of the earth that could take the new 10-speed transmissions that the pickup trucks are moving to and shrink them enough to get them in. GM and Ford could not do it themselves, so Linamar makes every 9-10 speed transmission that goes into a GM and Ford pickup truck. And the stock stock now is just a little bit north of $50. In January, February, the stock was selling at $81 because of the long-term growth that this company has. And then the Ukraine war situation happened, and it created extra dislocations. The other thing that happened is the Canadian border shut down by the protesters, the vaccine protesters, or whatever they were. They shut down both the Manitoba border and the Windsor border, which a lot of the Linamar's products cross back and forth from. And the other thing, of course, is the shortages of chips and things that have affected the whole General Auto story. So we'll just talk about it. Linamar, because it hasn't been able to expand its business because of these events, the cash flow that came in from depreciation, et cetera, just piled up, and they went to actually being a cash-free company, and they've now got a cash flow of over 900 million. Now they just made 2 acquisitions, which will reduce that. But this is just to point out that a well-run company, when the business goes down, their cash can pile up. And the other thing about this company is we just want to focus on in 2018, Linamar had $163 of content on every North American vehicle. In the first quarter, they had $206. In Europe, they went from 78 to 100. So this is a company that is growing market share, and because of their ability to engineer products and their quality of service they give to their customer base. They also, and the other thing is that they have recently won lots of new business on EVs and hybrids, and right now about 25% of their automotive sales go to largely hybrid cars. And with the new wins they've had, that's going to go to 45% in over the next 5 years, which is pretty impressive, because I don't think even by 2026, 45% of the cars on the road will have electric propulsion systems, although it is rising rapidly in Europe, and China has also pushed that. So they also have 2 other businesses. They own a company called Skyjack, which makes a lot of the lift equipment you see around building sites. They are the dominant supplier of that in North America and have a good share in Europe. And that business has a huge backlog. And again, once they can get parts, that business is going to do very, very well. And they also have they've got some farm equipment businesses that mainly make grain headers that are sold into North America largely. But with the Ukrainian situation, the farmers are all going to be wealthy enough to buy these. But both these, the Skyjack division is now up and basically running at full capacity. The farm business is still hurting because of supply disruptions, but that should come about soon. They've got the next quarter will remain tough for them, but Linamar believes that the auto business is going to unlock itself starting in the second half of this year. And I can tell you a little bit of that. Let's talk about chips. So back in 2021, when the COVID situation started, the auto companies realized that they were going to probably sell less cars. And so they, given the way they operate, they told all their suppliers that they were going to cut back and not take the same amount of deliveries. They told this to the semiconductor companies. And the next day, Hewlett Packard and Dell and Apple all phoned up and said, gee, with the stay-at-home business, our business is taking off, and we'll take all the extra chips you can give us, because everybody's buying a computer to work from home, or et cetera, or putting in printers at home. And so the chips moved from the auto business to the home office business. But now we're seeing the home office, Dell and Hewlett Packard are starting to slow down as people go back to the office and turn their computers on at work, and they don't need another computer at home. And so that chip supply is starting to unlock and will be available back to the auto companies. And so Linamar is actually forecasting double-digit earnings growth for 2022 and 2023. And we think as confidence comes back into the stock, I believe it can double in price in the next year and a half. And with that, I'll turn it back to who's next here, Jamie, to talk about the Income Growth Fund.
Yeah, thanks, Bruce. So yeah, I'll go through our income fund quickly. We won't spend as much time on it in the interest of time, but I mean, you can see this is performance year to date up 4.6%. If you look right below that chart, you can see partially why that gets explained is that our benchmark for this is 80% the S&P TSX and 20% the S&P 500. So a much more Canadian market focused product. It's a product that we have for Canadian investors who are looking for a high dividend out of a fund. And you can see this fund delivers that. It has a yield of 5.5% at April 30th. And every company in this portfolio has to have a dividend yield over 3%, and to be included at a time of purchase, it has to be 3.5%. So we're definitely looking for companies that have strong, high dividends that we still like to see them grow. They maybe don't grow as quickly as some companies that only pay a 1 or 2% dividend. But definitely lots of opportunities in this fund. And this fund's also benefited, has more resource and commodity exposure, more real estate, so a little bit more defensive on those standpoints, and also benefiting from the commodity inflation that we're seeing a little bit. And then that upside downside capture, again, you always want the upside capture to be higher than the downside capture, because that means that you make more money on the way up than you do on the way down. But a little bit less volatile than our global growth fund, again, due to the defensive and income paying characteristics of this fund. And I'll just flip to the next slide, and you can see what types of companies are in. But just looking at the top 5 companies, you can see that mixed difference. So our largest company is Canadian Natural Resources. This is one that we actually just added to the fund in January 2021. And it's done very well, more than doubling in that time. But Capital Power has been a large holding in this fund, usually number 1 or number 2 for the last 3 or 4 years. And again, this is a utility or power producer with operations in Alberta, now moving into the United States, some in Ontario. They just run power plants, wind farms, natural gas facilities, and pays a nice dividend that usually grows 7% a year, and it yields around 6%. Alaris Equity is an alternative financial services company. It's yielding 7%. Right now, they're only paying out about 60% of their cash flow to fund that. And then Alaris just looks to invest in smaller private businesses where they take a large dividend out of that company, so maybe somewhere around 11-12%. And then they can finance that with their equity that pays out a 7% yield. So it's been a nice little business. And then the next 2, Chemtrade is a chemical company that's in a little bit of a recovery and benefiting from the strong commodity markets. And then finally, Exchange Income Fund is again, it's a conglomerate of Canadian businesses, mostly focused on aviation. So they have a lot of small airlines that operate in Northern Ontario and in the prairies, and some in the interior of BC, as well as a mix of other businesses, such as some technology that goes on to high-rise windows. So they install the windows for the high-rise, and they have a very good company that does that. And they even just bought now an environmental matting company. So when you're doing remote work, you can put down these wooden mats across the landscape instead of having to build gravel roads. So it's a lot easier on the environment. And with the resource sector picking up, that business will do very well, especially when you need to access these remote areas that can be really muddy or swampy, or at times of year, and like in spring when everything's just wet and slippery everywhere. So and that company yields around 6% as well, and then they just raised their dividend 5% last quarter. And so we'll throw up our 2 portfolios during the Q&A. If you want to send them in on our question box, we'll see what we have time for. But I think from now I'm going to invite Sue Dalhoff on. So Sue's our advisory board chair, has been with the company since we started, and she's going to moderate the questions for us, and we'll do our best to answer as many as we can.
Thank you, Jamie. And thank you to everyone for your questions. We'll try to get through, as Jamie said, we'll try to get through as many as possible in the next 10 to 15 minutes. For those of you that need to leave right at the hour, we understand and would like to thank you for participating in today's call. If you'd like further information about the Murray Wealth Group funds, please do not hesitate to get in touch with one of the members of our team. For the rest of you, I'm sure the PMs would be happy to stay on and entertain your questions for another 10 minutes or so. Some of the questions are around common themes, so I'm going to try to summarize them where I can. They're basically around the market environment and specific stocks and sectors. So if I could start with this first one, and I will send this to you, Jamie. Could you please discuss Aritzia again and what your time frame and price target is for this stock? Thank you.
Yeah, thanks for the question. So Aritzia is, I'm going to put up our global growth fund here. It's our 6th largest holding in the portfolio. And I mean, if you're not aware of Aritzia, it's a women's, they call themselves affordable luxury fashion house. So it's nicer clothing than what you'll find at most stores in the mall, but not the luxury price tag that you find with the true luxury Louis Vuitton, Chanel type brands. So some more of a step in between. It's been a very successful Canadian company. It was started by the current, he just moved aside from the CEO role into the executive chair role, but the founder is still with the company, still overseeing it. They started with one store in Vancouver in 1984, expanded all across Canada over the next couple of decades, and then came public about 5 years ago with the goal of becoming as famous in the United States as they are in Canada. And that was the bet we made when we first invested in 2018, that in Canada, we know the product, we know their customers, everybody loves the product. And we don't think that, we've seen the success of Lululemon move from Canada into the United States, and we thought Aritzia would be able to follow in those footsteps. And so far, it seems like it's playing out perfectly. They've opened up, they're up to about 40 locations in the US. Their sales in the US are growing very healthy, kind of like a 30% annual growth rate. And now, thanks to the growth in e-commerce, Aritzia has learned that they don't even need to open up as many stores in the United States as they maybe initially thought. So Aritzia has 60 stores in Canada, so almost every little mall will have an Aritzia in it. Where in the United States, they're finding we can only, in a city like Los Angeles, Aritzia can open up 5 to 10 stores and then use e-commerce to sort of serve all those other customers. Whereas in Toronto, where they're much more mature and have stores from the 90s, Aritzia has 30 locations. So they're finding that they can be much more productive by adding on e-commerce. And so they can open up one store in a new city, and then that store can almost serve as a home base, and then they can use e-commerce to sort of serve all the demand around it. So it's been very good. It's pulled back a lot with the market, and there's a lot of focus and worries on a potential recession. So consumer stocks typically get impacted in those type of markets. But when they reported the results 2 weeks ago, very strong. Their guidance going forward was strong. The company is very well capitalized. So they, again, that's a theme for a lot of our companies. They have really no debt aside from what you would consider their leases for the stores, but they don't have any long-term debt. They have net cash on the balance sheet, healthy cash flow, and they're not seeing any slowdown so far, and they're going to continue to execute this plan of opening more stores in more cities in the United States.
Thank you, Jamie. Mike, if I could ask this question of you, please. How likely, there were a few questions around the same subject. So how likely are the tech stock values to return anywhere close to multiples of several months ago?
Hey, that's a great question. And the market has definitely re-rated these tech stocks, and they've put them in a new light. I'd say a red light, actually. But taking the multiples down dramatically, as the Fed has been talking about dramatically increasing interest rates. Names that were priced for hope 6 to 12 months ago are now getting much closer to show me stocks. Jamie showed you a great slide earlier on how well our names are how well positioned our names are, how well capitalized they are, and their ability to weather this storm. In markets like these, the baby gets thrown out with the bathwater, and we think we have some of those babies, like Google, Meta, Intuitive Surgical, names like that. And you may not see the same, euphoric multiples that we saw in the past, but we think our names are undervalued. And we think these stocks will outperform over the long term.
Thank you, Mike. I have a second question that I will ask of you as well, if I may. After every rate hiking cycle, there's typically new market leadership. Please share your views on what you think might be the new sector or sectors leadership as we emerge on the other side of rate hikes, assuming no recession.
Wow, clearly a very savvy questioner. Thanks for your question, and a very important one too, because the market today has, it seems like, multiple personality disorder. Leaders one day are dogs the next, and it seems like we're repeating that process every day. It's quite painful. I'm getting whiplash as we speak. But given our bottom-up approach that we take, we place price targets on all our holdings. And these targets are based on how we see that specific company executing their strategy over the next 18 to 24 months. But those targets would be driven by, potentially driven, or we consider macro-driven events in those targets. And from those macro standpoints, we're thinking about things today that I talked about earlier. For example, the medium-term impact on the North American industry, the North American energy industry, with the supply chain changes that are going to be coming in Europe because of the Russian-Ukrainian war. And on top of that, how much does this accelerate the move to renewables, especially within Europe, and who will win those? Onto this point of COVID, like, our global supply chain is going to change from pre-COVID times. I mean, the headlines you read certainly seem to think so, but we're not so sure. What's the impact on automation? Do people want less exposure to labor because of all the challenges with labor and COVID, et cetera? Healthcare, personalized medicine, genetics. I mean, we met with AstraZeneca management last week. That's one of our holdings. And they were talking about R&D and step changes ahead in gene sequencing, genetics, data science, and artificial intelligence. So there's lots of things going on that's on our radar. But also, I think what you're asking is, where's the next monster profit pool coming from? That pool, we think will probably stay in large caps for at least the next 5 years. It's hard to see because it's hard to see really competitively what's going to happen to these business models in terms of profitability. Over the longer term, from all we hear, as I mentioned, the healthcare sector has a lot of potential. Also, we're thinking about, the move to hydrogen is on our radar, definitely, but the leaders are completely unclear in that sector. There are no profits yet. We have a long way to go, and it's not a straight line. So I hope that helps.
Great answer, Mike. Thank you very much. This next question comes from a gentleman that Bruce and I worked for when he headed research at Nesbitt Thompson, and we were young, wet behind the ears, I think it's fair to say, research analysts. This goes back some 35, 40 years ago. It's so good to have you with us today, Phil Heitner. The question is on CTS. Everything they do has worked out. Q1 earnings were okay, but the stock is very weak. What are your thoughts on CTS? And Jamie, I feel free to answer that, or Bruce, go ahead.
Yeah, so CTS is Converge Technology. So it's one, you can see it here, it's a holding in our global equity growth portfolio. And what Converge is it's a Canadian IT service company that's actually looking at rolling up these little IT service providers across North America, and now focused on Europe, initially in Germany and probably the UK soon. And so what they're trying to do is they think they can acquire these small local companies, bring in some synergies in terms of working capital, buying power, so bringing them in and getting bigger discounts on some products they buy, the usual stuff like back office, merging and lowering your accounting and financial costs, those type of things. And then they can also cross-sell by adding more and more services. So a lot of these IT service providers maybe specialize in one or two types of IT services. There's a broader array. So obviously we talked about Microsoft. It could be an AWS shop that focuses on the AWS cloud. IBM and HP and Dell, they all have different systems and different softwares that they rely on these sort of third-party regional IT sales companies to implement that with the end customer. So Converge is rolling these up and thinks that they can get a lot of synergies, and that the sum of all of them will be greater as a whole than separately. And yeah, it's still early days. We think in the strategy there is around 2.5 billion run rate of revenue, and they want to grow that to 5 billion by the end of 2024. So still a wait and see to see how it ultimately plays out. But what we want to see is the margins expand over time. It's easy for them to go and buy a company and get that revenue, but anybody can just go out and buy companies and get revenue. For the Converge story to play out how we expect it to, we want to see those synergies come in and those margins increase, and the productivity at each of these companies increase as they roll them up. So we're seeing that their last quarter, they're seeing strong demand, but they're also dealing with the shortages and ordering PCs and some of these products that's creating a little bit of dislocation. But we still haven't seen the gross margins tick up like we think they're going to. And I think once we do that, the stock's going to start to perform well. But I'll just flip back over to the slide here. Converge is again very well capitalized. They raised most of this cash in equity raise, so they're looking to use that money to buy other companies. But still a very, very healthy level of free cash coming out of the company as well. So 10% free cash flow yield for Converge. So we do think that at this level it's attractive almost regardless. And if they can really execute the strategy, we think there's big upside in it.
Thank you, Jamie. Another one for you, if I may. Which of the REITs looks most attractive to you now, given that they have sold off substantially from their highs?
Yeah, thanks. So real estate is it's not a huge focus for us. We do get to see the special odd opportunities as they come through our office, and we do own a few here in our income fund. The great thing about our income fund is because it's a smaller pool of money overall, we're able to buy some of the smaller REITs out there that we think maybe offer more attractive values than some of the larger ones, because they're maybe not as liquid from a stock trading perspective. And so our largest one, which we've just been buying recently, is European Residential REIT. So European Residential has first off, they have a partnership, and they're a big investment from Cap REIT, which is a big Canadian apartments REIT. And so European Residential is focused solely on the Netherlands. And we just think there's better trends in the Netherlands than you find in North America. European Residential yields around 4%. It's growing that cash flow around 10% a year. So we're expecting the dividends to grow about 10% a year. And then some other things like the interest rates and mortgage rates in Europe are lower. So you're able to buy these properties again at lower cost with lower financing. So it's a little bit more attractive on that standpoint. And then European Residential, because of the market dynamics, it is I don't want to get into the whole, we actually wrote up it as our last research report. So you can head to our website to get all the nitty-gritty details. But they have a nice step up of rental increases coming when apartment suites turn over. In some cases, they can almost charge 40% more to the new tenant coming in than what the old tenant was paying because of the rent controls. And so you do get a nice sort of natural growth from that. The rent controls in the Netherlands are inflation linked. So if inflation does stay higher for longer, they'll be able to increase their rents faster and faster. And yeah, just a nice little REIT that we think is going to grow very, very quickly.
Thanks, Jamie. Another one, appreciate your views on Zalando, which the firm felt positive about at much higher levels.
Yeah, so Zalando, it's in our global equity growth portfolio. The stock's been killed this year. There's not a pleasant way to say it, and it's not been fun to own it in this time period. But Zalando, we'll just talk about what it does. So Zalando's a European e-commerce company focused on apparel and selling wholesale and third-party apparel. So most brands in Europe will sell through Zalando, whether it's Nike, some local European brands. There's one called Mango. they have a huge clientele base who sell on their product, and it's really just they sell either wholesale or they sell what's called partner program, which is third party, which is similar to how Amazon, certain sellers can sell stuff on Amazon. It's not Amazon selling it to you, it's a third party company, and they just use Amazon as their interface. And so Zalando, they've been expanding very quickly. They started in Germany and that region. They've been expanding now all across Europe. They're not in Ukraine or Russia, so they're not directly exposed to that, but Europe obviously is feeling the effects of the war through higher energy costs and lower consumer confidence than North America. So that's been one hit as well. They're also dealing with the supply chain issues as well, because they do a lot of delivery. So that's been a factor there as well. But we really do like Zalando. We even heard from Amazon in their most recent quarter that as e-commerce, we sort of hit this short-term peak coming out of COVID. Companies, if they want to grow, they're going to need to continue to look and expand their distribution. Zalando has 40 million members across Europe, and the very high consumer satisfaction rankings. And Zalando will do everything for you. You can ship them the inventory. Zalando will sell it for you. Zalando will just do the fulfillment. Or there's even something called connected retail, where if you own a store in Spain, and you can put a product in your store on Zalando's website, it'll connect into your inventory. And if somebody in Poland logs into Zalando and wants to buy that, they'll buy it through Zalando. Zalando will handle the delivery of that to that customer. So it really does give, especially smaller companies, really broad reach right across Europe. And the company's still expanding. They're expanding down to beauty, so they have a partnership with Sephora to sell Sephora products. And we still think e-commerce is going to outpace mall-based and brick and mortar-based spending over the next decade. And Zalando is really perfectly positioned to do that. So we see the margins really stepping up in the next couple of years, as well as the solid revenue growth for the next decade. So we think it's a good long-term hold.
Thank you, Jamie. Bruce, I have one I'd like to throw out to you here. Simple one. What are the possible lows what are the possible lows, I believe that's market lows, if we go into a recession? Not so simple.
Yeah, it's not, yeah, I mean, who knows where the low is? I mean, you can see things, we're showing you some stocks we believe are cheap. Does that mean they can't get cheaper? No. But first of all, let's talk about a recession. Recessions are difficult to have when, you can't get, there's a lot of stuff still to happen before the recession. The economy has to recover. Anybody who wants a job can get one. There's a massive shortage of, we'll just use automobiles, that automobile production is still, there's still 3 to 4 years of demand just to catch up. And so like a recession is only can be only caused in a sense by, just fear itself and people just shutting down for fear. But the U.S. consumer is still fully loaded with cash, or as strong as they've ever been. And so I think a recession will occur out 2 to 3 years from now, when we get the flush through of the fulfillment of the economy, the shortages of supply are caught up. Then inflation's going to come down, because a lot of this inflation is, as the Fed called it, transitory. It turned out to be more transitory than they believed, and the Ukrainian war has increased the transitory nature of it, especially in energy, where it's going to take at best 1.5 to 2 years to rebalance that. So I think the probability of recession is stronger in late 2024, 2025. As to the market bottom, I've lived through 1974, 1979, 80, 82 was the worst one, where they slammed interest rates to 20% to get inflation under control. This is not the same type of inflation we had in the 80s. When I was a young guy, I was able to, my salary went from $5,000 to $30,000 in about 4 years, and it was largely the same job. So it was just, it built right into the economy, which it's not as of yet. It may, I don't think it will, but it's, you can't say never. So yeah, I think we're close to a market bottom. As we say, stocks are cheap. I can go, if I had a bunch of money, I could go out and buy stocks today that I'd feel very, very comfortable with. And just looking at the equity growth funds up there, Manulife's got a 5.5% dividend. It's a beneficiary of higher interest rates. Raytheon, airplanes are going to come back. We've got a war in Ukraine. They supply a lot of the components that are being consumed in the war. They have technology. They're going to supply all the engines to Airbus. Airbus has got 7,000 planes still to deliver over the next decade. Mike talked about AstraZeneca. We saw that company. They are getting approvals for new cancer drugs almost every day in some country. So I think we talked about Linamar. We talked about Aritzia. Bank of Nova Scotia. When the copper mine, the world needs more copper mines. Bank of Nova Scotia is positioned in South and Central America, and will do well. It's got a nice dividend yield. So Louis Vuitton, every woman in the world wants to spend more money there, so that will happen. I think, I just think we're in good shape. It doesn't mean they can't. Every one of these stocks could get cheaper though, just given the fear and the negative news that we're seeing. But we're seeing the news being reported is what happened, not what's going to happen. I mean, what happened was we had inflation, we had dislocation, we had a war. Companies are adjusting to that, and as they adjust to it, the situation it'll be gradual, but it will improve. As we talked about Linamar going from, having a disaster first and second quarter to the second half of the year being very strong.
Well,
Go ahead, Jamie.
Self-correcting in that, like Walmart and Target both said they hired too many people. Amazon as well. We talked about a labor shortage, but then they were finding companies that had too many people, and they're coming back to Facebook, Netflix are slowing, or in some cases laying off people or slowing hiring. So we're definitely going to see, we think, the labor market loosen through this.
Yeah. But every restaurant needs employees, from what I hear.
Yeah.
Bruce, just another question for you here. I know you said, you're not expecting a recession, but would a recession have a positive impact on long duration investments by capping or reducing Federal Reserve interest rate increases?
Well, a recession obviously would deal with the inflation bouts, and inflation bouts would allow rates to be reduced. The rates were reduced to extreme lows, though, given the the COVID situation, and I think a more normalized rate would be probably 2 to 3% in this current environment. So I don't know that it wouldn't be substantially lower than where it is, but we just need the stability will, most of us can totally live with 4% rates on consumer loans, etc.
Perfect, thank you. And Jamie, if I could ask one of you here, please. Do you follow Costco? If such a high percentage of Costco revenue comes from fees, is there ever a point that represents value now that it's down 30%?
Yeah, so Costco, we used to own Costco in the global equity fund, and we sold it obviously much too early because stock continued to rocket up. But I think Costco, as we're finding out in these last few days, and Costco now is down, as they said, 25-30%. No company is immune to some of these just broad market factors. You can't be worried about the economy and worried about higher interest rates, which impacts high valuation companies, but then just have one company that isn't affected. So now we've seen, it's definitely more attractive. You can't say the stocks, well, in certain cases it isn't, but there hasn't been anything that we think affects Costco's long-term plans with its, there's lots of growth in China. They're still opening up new warehouses all across North America. I was there on Sunday and it was jam packed. So I mean, it's definitely a strong company. The multiple is always way too high for the last few years, and so to see it come down, you know, makes it more attractive. We'd have to do a little more homework on it to see if we want to recommend buying it. But it was always too expensive for us, and yeah, we'll see what happens over the next few weeks. We'll see what they report.
Maybe I could just add a little bit to that.
Sure, Mike.
The questioner, Costco's membership fees are only 2% of their total revenue, so it's not a big percentage. So what really drives Costco is their day in, day out good deals for consumers. And as Jamie alluded to, it's a very, very expensive stock, even after today's pullback, trades at 32 times. So it's twice as expensive as Facebook or Meta. But it's shown a management track record and management track record over the last 2 decades, which is second to none, essentially. That's why it has those high multiples. But it is one that's on our focus list that we keep on there with target prices to make sure in these dislocations, when babies do get thrown out with the bathwater, these are ones that we're going to be reassessing going forward.
Thank you. I just have one very last question, and a difficult one, but if you could pick only 3 stocks in which to double your positions within 18 to 36 months, what would they be? Feel free, anyone who wants to jump in and answer that.
Let me take that. We
Sure.
in our presentation outlined 3 stocks. So we'll leave it at that. We think most of the stocks in our portfolios should do well over the next 18 months. Some sort of more unique ideas might be, is COVID really going to end? If it does, Air Canada is going to do extremely well. MasterCard will do well as world travel opens up. We talked about Raytheon. We talked about Converge. Major Drilling is a $10 stock that should double as we try to find more ore bodies to feed the electric vehicles of the world. So Morgan Stanley pays a 3.5% dividend. Has been around for 200 years. Will probably be around for another 200 or 300, and is a rock solid. Every high-end family in the world has their money with Morgan Stanley. So there's lots of choices.
Thank you, everyone, for your questions. And at this point, I'd like to pass the baton back to Bruce, who I'm sure would like to have a few final words and to thank you all for coming. Thank you.
Yes, thank you all very much for joining us for our presentation. We hope you found it both interesting and informative. We were attempting to fight fear of fear itself, which has dominated some of the markets for the last few months. Now, there are real issues still to face. We still have an inflationary boat to beat, but I expect we will see inflation rates gradually come down over the next 12 months. And as I said, the economy should pick up as we make up for the shortages of the pandemic relation, and the world starts to function better. That may take the end of the Ukraine war, the disintegration of Russia, or something like that. And so it could take a while, but we think the track will be gradually up from here. So once again, thank you very much, and we look forward to seeing you at our next quarterly presentation. Thank you and goodbye. Enjoy your summers.
Thank you.
Bye-bye.